Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Yesterday marked the end of the 2021 financial year. And what a year it was. It began in the midst of the COVID pandemic and ended with many global share markets near record highs and economies booming. For many investors, including all of us with superannuation accounts, returns for the financial year will be among the best in a decade, hopefully. To talk us through the year, the good, the bad and the ugly, I welcome back Centennial Asset Management Principal Matthew Kidman. Matthew, welcome back to Fear and Greed.
Thanks, Sean. Hope you're well.
Very well, thank you. Now, how would you characterise the last financial year for equity investors?
Well, it's been terrific, hasn't it? It would have been nice when we went into COVID to say, well, we think that the market would recover, hit a new high within 18 months. Very quick recovery. But it's been a bit more nuanced than that. Over a full 12 months, and I said it to you before, last year was like investing a lifetime in a very short period. Well, that thematic really hasn't changed. There's been a lot of different sectors that have run at different times. It hasn't been a case of just be long the market. You would have done a lot better if you could switch sectors, switch companies during the year. It was really I hate to say it, but a trader's market more than anything. The overall market did 25% in Australia, which is terrific. But there would have been opportunities for some people to do 40, 50%, I would have thought.
Okay, so let's start with the good. Banks had a great year.
Yeah, banks had a terrific year because as we started on July 1, they were on their knees. They were at the centre of the COVID crisis. There was a lot of loan deferrals. There was a lot of help for the general public. There was combination with governments to make sure we got out. They basically became a government arm and a way of controlling the shutdown of the economy. Then as it went on, as we got into August, I think they hit bottom and they took off from there because I think the market became aware that the economy was going to recover quicker. The bad debts that everyone feared, the provisions weren't as bad. They got their costs in order and the economy turned out all right. So you went from a low base to a high. But here we are at the end of the year and I think it's changed for the banks. Sure, they've got capital to give back. That's a great thing. We should see that in the next 6 or so months from all the majors because they've got excess capital, been selling assets, they've been accumulating money. There was a period where they didn't pay any dividends, they weren't allowed to. That's all back, you'll get the capital back, but valuations are fairly full, we would think, especially Commonwealth Bank, the biggest and the best returning bank of the big four. We would think that maybe it's going to be a lot harder from this point onwards. If they did go higher, I would have thought it's on the back of now something we haven't experienced in a long time with the banks, and that's reasonable loan growth, expanding their book, which hasn't happened for a long time.
Okay, now another sector that fits into the good is technology, and particularly in the first 6 months of the last financial year. Now, they've come off a bit, and the buy now, pay later groups Afterpay, Zipco have come off a lot in the last couple of months. Xero's off a bit. How do you read the technology sector for the last 12 months and going forward?
Well, the technology stories are really interesting. They were the safe haven when we went into the COVID crisis because they could continue to grow. And in fact, the world moved towards them. We were doing things virtually more than we were previously. We all know that. And then they went through the middle of the year and interest rates started to rise as economies started to find their feet again. And there was that fear, that bubbling fear of inflation. And the tech stocks were sold off and investors looked for that cyclical upturn, those players leveraged to a growing economy. That was all fine. But about April, it turned again and they had another run. So in the last few months, it's been very interesting. And this is what's made the market incredibly hard on my opening comments was from about April onwards, everyone was talking about inflation. But lo and behold, it was then that the US 10-year bond, which helps us value assets all around the world, including equities, it kind of peaked. It got to 1.75 and then it started to gradually come off. And so the US investor was telling you maybe they're not so scared about inflation. And guess what rallied then? Back into your structural growth companies, mainly tech. So we've seen healthcare, tech-related stuff such as Cochlear and ResMed. And then you've got the tech companies that are pure software plays. They started to rally. And of course, and you mentioned the buy now, pay later. Afterpay is probably the bellwether these days, given its size. It peaked at $150. In that period where it said it was soft, it got down to 85. And then in the last few months, it's got back to 130. If you could have traded that, you could have made 100% on your money.
Now, I know small caps is an area of particular interest for you. How'd they go in the last 12 months?
Yeah, small caps has been a pretty good place to be. And for the reasons we just talked about. In the early days, the recovery days, small caps have got a lot of retailers, and we all know that once once we came to grips with COVID, the house was spent a lot on the house, and that helped the retailers. We need a lot of equipment from JB Harvey Norman to set up at home. And then we looked around home and we wanted to buy furniture. We wanted to start buying cars. So car retailing was really strong. So that really kicked off the year. But that tapered off a little bit. And then what took over were the miners. And there's a lot of small cap miners, and that became the flavour of the day. And then the last few months, they've come off again for the reasons we said. They're the reflation trade miners. And so we went back into those smaller tech companies again. So it was a really funny year, but from pillar to post, it was a terrific year, but you had to be right on your game to pick the eyes out of this market.
Yeah, you mentioned the miners. Now, the big guys, Rio, BHP and Fortescue, the big iron ore miners, did well on the back of strong prices, but they're actually outperformed by lithium player like Pilbara Minerals and Lynas Rare Earths, some of those sorts of commodities.
Definitely. So that's an interesting story in itself. Of course, we've got record high iron ore prices, which you would think at this part of the cycle would surprise most people. But at a certain price, that has become a bit hard to go higher. And so since December, halfway through the year, the iron ore guys have basically gone sideways. They've been up one day, down the next. They're just chopped sideways for the whole 6 months. In the meantime, the lithium players and the like, and copper and nickel have really come to the fore. What's been the driver of that? Well, it's twofold. It's the economy recovering, or global economies, because they sell into the global economy. But the second thing is that we've got, the battery phenomenon that's taking place. And obviously Australia's in a really good position to take advantage of that. So all these inputs into batteries that are going to run our homes and our cars and so on, it's starting to take off big time.
Stay with me, Matthew. We'll be back in a minute. My guest this morning is Matthew Kidman, Principal of Centennial Asset Management. Now, the bad of looking at those gold miners, and that's very much on the back of lower price of gold.
Yeah, gold has been a hard one. It has had moments where it's done okay over the year, but gold will typically run quite well if the US dollar is weak. And we did see that in periods, but in the last 3 or 4 months, the US dollar has bottomed and started to rally again. So gold's been sold off. Gold's a hard one, as we know. It's also been challenged by Bitcoin and the cryptocurrencies as an alternate for a store of wealth. Whether you believe in that is up to you. I personally don't, and I think gold fits into that category as well. So it doesn't surprise me that it doesn't take much to knock the gold run off, and that's what's happened. It's turned out to be disappointing. Or there's always a lot of gold bugs, gold bulls, whatever you want, what animal you want to put next to gold, because they're always scared. They're always worried about what's going to happen. So you've got to own some gold. I'm not in that camp, but at times they do get it right.
I was looking at the market over the last 12 months and thinking about the ugly ones, and there have been some very specific examples. A2 Milk one, because of their way to market, has been absolutely crucified via the pandemic. AMP is another, and we all kind of know about that. But really the energy companies are the groups that just, the big guys, Origin, AGL, they've done really poorly.
Yeah, so energy is quite interesting. The two that you're given there is the retailers in the energy market, people selling to us. And that whole energy market has been turned upside down, as we know. And so there's just a lot of different types of energy coming onto the market, not just the traditional, oil, gas, coal. We're getting a whole bunch of new green-based or alternate energies, which is great. But what it's saying is there's different ways to market now, and people is powering their homes and cars and so on with different energy, and that's really hit them. Now, the actual oil producers is interesting as well, because if you remember back April in 2020, we had that bizarre period where oil went negative. And we all sat here and said, well, how could that be? Well, they were storing it in the US and had nowhere to store it. So it was a matter of tipping it somewhere down a hole. But it's recovered, and it's had an amazing recovery. But the stocks haven't gone with it, which is a real eye-opener.
Why is that? Woodside, Santos, those guys, why haven't they?
They just haven't, and I think it could be the start. I may be wrong, but probably the best explanation we can give at the moment is that there's not going to be a lot of fossil fuel exploration going forward. So supply is just going to continually tighten up, and we know the reasons for that. And most countries will move away from those fossil fuels. But that doesn't mean there's not demand for them in the short and medium term. So I think you're going to get demand at different times outstripping supply, because there's just not a lot of new supply coming on. And so, strangely, in the decline of the fossil fuel, and we've seen it a bit recently with the coal companies or coal as well, the actual price has spiked quite sharply. But the companies haven't really done a lot. And I think that's the reason why, because everyone thinks the fossil fuel sector is under a lot of duress and will be for the next decade or 15 years. However, their products that they produce will continue to be in demand because we have to do this transition. So supply short because there's not much exploration because we know it's got an end date, but we still need it for the moment. So it's going to be a really bizarre where the commodity price stays high possibly and the companies don't do much.
So what about the next 12 months? We've discussed 2021. As you said, if we knew 12 months ago that the market would be up as much as it is, 25% in the last 12 months would be all pretty rich, I'd imagine. What do you reckon will happen and where do you think the standouts will be in the next 12 months?
Look, I think it's been a market full of thematics. So it's been more about getting the thematic right than the individual company right at that big end. Anyway, I know I operate in the small cap world, but at the big end, whether you want to be in banks, whether you want to be in miners, whether you want to be in healthcare, depends a lot on the thematics. So what we have to watch in the 12 months going forward is that a couple of things. Is that 10-year bond yield in the US. When it was climbing the yield and everyone was worried about inflation going back through that first quarter of this calendar year, January through March, you had to stay away from those structural growth stories because their PEs were starting to get crunched. Then when the 10-year bond yield came off, everyone jumped off the reflation trade and went back to those structural growth stories. So it's very much around that. So I'd be watching it really, really closely if you can. A rising bond yield will mean you want to be back on the cyclical companies that take advantage of an expanding global economy. If they stay where they are or go down, I would be staying with your structural growth stories, tech and healthcare and things that will grow despite the economy. Now, which way it goes, I don't know. My best guess is that we are still in the middle of a reflation trade, and that went from probably June last year through to April, and we're having a pause. And the pause is probably around the fact that investors aren't as worried about long-term inflation. And it's run into the reboot on the economies around the world. So we've got America opening up and they're all very bullish and they're getting the vaccine out there and they don't really care that there's cases. We're going to open because we're vaccinated. You've got Europe in a funny spot where they're vaccinated, but they're stop-start. They're struggling. They're getting caseload, especially in the UK. We'll see how they go. And Asia probably is stuck in first or second gear as a growth engine. I know iron ore prices are high, but we've seen the data out of China a bit soft. We've seen the virus flare. So I think we've got to work through this middle part of the year. I think COVID hasn't left us, and I think it's going to mean that outright growth stalls for a little bit. I think that's a great buying opportunity into the general market because in that scenario, I think it chops around because we're at record highs. It needs a bit of a breather. But I think in this middle part of the year, as Europe and Australia obviously fits into this bill as well, given we're in the middle of a lockdown again now, and Asia try and work their way through the virus, and then the vaccine starts to get broader spread, not just in the developed countries. And I think going to the back end of this year, you're probably going to have a pretty good market to invest in because most people will be up and running. Most countries will be up and running again.
Fantastic. Matthew, thanks for talking to Fear and Greed.
Thanks, Sean.
That was Matthew Kidman, Principal of Centennial Asset Management. This is a Fear and Greed daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.